When we were writing the sort of introductory blurb or essay for this session, we had a number of goes at it. The first version was quite upbeat in the first quarter of this year, but by the time we sort of revised it in the summer, the version you've got, it was quite doom and gloom. American growth under 2%, unemployment up, house prices crashing by a third since 2006, Obama mired in rows in Washington over deficit reduction and possibility of the lights going off in the White House if a deal couldn't be struck. Since then, we don't know if it'll be long term or not, but market surge on US growth and Euro plan. So annualized growth figures for American GDP are now up at a staggering 2.5%, at least on the third quarter, which may not be earth-shattering, but is better than they predicted, less than 2%. And Wall Street's fear gauge has fallen by 15%, which must be reassuring, at least in the short term. So there is obviously a fluctuation and volatility in optimism or pessimism about the US economy. But hopefully today we can have a look at some of the realities of its situation and whether or not it has the capacity still, as the world's biggest economy, to reinvent itself and keep pursuing the American dream, or is the best that it can manage in today's circumstances one of accepting and managing a relative decline, albeit, but nonetheless a definite secular trend downwards with the rise of China and the BRICS. So, a lot to talk about, but we've got three panelists who will help us try and understand these questions in the order in which they're going to speak. Very pleased that Martin Wolf, here on my left, is able to join us. Martin is very, very difficult to introduce, I think. He's one of the leading economists in the world today. He's the associate editor and the chief economics commentator for the Financial Times. Wrote recently an excellent book on the global credit crunch and crash called Fixing Global Finance. But he's so much more as well. He's very much part of the World Economic Forum and required reading if you want to understand what's going on in the world, either his weekly columns in the FT or any one of his books. So thank you for joining us again, Martin. Second to speak on my right here is Professor Iwan Morgan. He's Professor of US Studies at the University of London. You'll find that he's not American. Unfortunately, we don't have an American on the panel today, but he is an expert in the US, in particular in the study of the US presidency and economic policy. Maybe Iwan will be able to tell us just what Obama has up his sleeve, if anything, to solve the current problems. And recently published a book called The Age of Deficits, Presidents and Unbalanced Budgets from Jimmy Carter to George W. Bush, which won the Newstat Prize in 2010. So thank you for joining us. And third to speak, Phil Mullan. Phil's an economist and a businessman. He's the Business Transformation Director at EasyNet Global Services. But in his spare time, if you like, he's also writing a book on why muddle-through responses, the kind of kick the can down the road repeatedly response to economic difficulties can't work forever, which is very poignant given the world's economic difficulties at the moment. He's a regular at the IOI Economy Forum, and we had a good discussion this summer which informed some of the thinking for this debate about how long the dollar can stay as world money, really. So very glad to have you here too, Phil. So, Martin.
The title we've been asked to address is the US economy resurgent or dependent? Is positive, not normative. It's a question of description and analysis, and therefore I'm not being asked to say what the US needs to do, though I imagine we'll get to that. And my answer to this is the US economy resurgent or dependent is, of course, a good economist's answer, which is it depends what you mean by resurgent and dependent. But basically, it's certainly not resurgent by its historic standards, though recoveries from recessions have got weaker in recent times. The last two were really quite weak, but this is exceptionally weak after an exceptionally deep recession, and there's no real sign that that's changed. I'll come to that in a moment. Is it dependent? Yes and no, in the sense that, like every other country, Its economic fate is heavily influenced by what happens elsewhere in the world in many different ways. But again, like every other country, it has a great deal of policy room for maneuver. The US certainly does. But one of its important constraints, which I'll come to in a moment, simply results from its size. There are things that the US, there are advantages in being very big, and there are also disadvantages in being very big. And I will come to that in a moment. My broad analysis of what's going on, which is actually going to inform radio programs that I'm involved in, BBC4 radio programs, which you must listen to because it contains some interesting discussion, is in terms of what I call the shift and the shock. The shift is the extraordinary rapid transformation of the relative weight of economies in the world, extraordinary in its speed, essentially the unwinding of the quite remarkable and obviously unsustainable lead that Western states in general and the US in particular gained in income per head by the middle of the 20th century. And this shift is occurring at extraordinary speed. And on IMF current forecasts, the Chinese economy will, on several measures, exceed that, on at least one and probably all measures, exceed that of the United States in size by the end of this decade. And the shock, is the end, in essence, of a generation-long leverage cycle, which, of course, is what's happening to us too. So we should be quite familiar with this, and that goes along with very weak consumption, very weak financial sectors, and a phenomena which very, very well described in the work of Carmen Reinhardt and Ken Rogoff, which has influenced many economists, and in which has basically come to the conclusion that if you have a shock like that in a developed country, it normally takes something like 6 to 10 years to work through it. Given that it's a global shock, and the US is so important to demand in the world as a whole, it can't rely on foreign demand to help it very much. So the likelihood is it'll be longer than that. That's what I've thought very much since the beginning of this crisis, and if I may say so, I've been absolutely right. And indeed it was on that basis that I critiqued very heavily the initial fiscal and monetary policies and other policies of this administration. So that's the basic analysis, the framework to discuss it. Where is the US economy today? Well, the results of the third quarter put it very, very fractionally above where it started at its pre-crisis peak in early 2008. So after 3.5 years, essentially the US economy has not grown. And the growth rate is well below most people's view of potential, so there's no reason to expect unemployment to fall, and unemployment is now roughly double its historic level, and much of it has now become long-term. So the unemployment figures start looking quite European. Inequality in the US on almost every measure has reached levels not seen for a century and are far greater than those in any other developed country. The deleveraging process remains at work, very much so. Households' borrowing is extremely weak, house prices are extremely weak, and the financial sector is burdened by the consequence of that, though not as much as the Europeans. And as a result of the extraordinary weakness of domestic private demand and the structural current account deficit from which the US has suffered now to an increasing degree over the last 20 or 30 years, it is inevitable, as again I forecast, that the US will have and does have massive fiscal deficits, and they are very large indeed by US historical standards. They are of wartime levels, basically, in terms of the previous experience of the United States. They've never had anything like this before in peacetime. So that's where they are. A crucial element in this, in my view, but it's by no means the only thing, is the way the US in particular has been affected by the rise of China and other emerging economies. I believe that it has played a large role in determining what's happened to the distribution of income in the US in particular. It has, of course, greatly accelerated the globalization of US business and its consequent and evident lack of interest in the fate of US workers. It has created a vast pool of global surplus savings that has gone overwhelmingly and continues to go into what the accumulators of those assets consider safe US assets, dollar liabilities, which have consistently sustained the real exchange rate above long-term equilibrium levels, and it's created a structural external deficit that has to be eliminated if these economies to recover normally. This situation creates, in my view, simply gigantic challenges for both the US and the world. For the US, it means that they have to rebalance the economy away from extraordinarily high consumption, which is what they had before the crisis, very, very low savings, essentially no household savings at all, no net savings at all. And they have to do this at a time of deleveraging and a very long period of weak growth. And that's likely to continue, and it's likely to mean a pretty stagnant economy. There's very little hope of a private sector spending boom in the United States. The household sector is really tapped out. The vast majority of US households have essentially no savings at all, and their ability to borrow at the moment has essentially disappeared. So if you want real consumption resurgence in this country, the only possibility is the consumption of multimillionaires, and since they're already basically spending whatever they want, there's no reason for them suddenly to go out and spend more, and it's not going to happen. This is what I call a yacht-led recovery, and yacht-led recoveries are not very robust. In this situation, American corporates, which are extraordinarily cash surplus and very, very profitable, have no reason whatsoever to invest in the US, and they're not doing so. They are holding cash in the US, investing abroad, and they're going to continue to do so. And this means essentially, if you think about the logic of this, the only way for the US to rebalance its economy is to become a net exporter. It needs to become a net exporter on a large scale. This is a very long-term and agonizing shift, and it means the rest of the world has to become a net importer. And good luck to that. Since these things won't happen, we are going to have a long period of global weak demand growth. And that means a real challenge for the rest of the world, because the role of the US as spender and borrower of last resort up to the crisis is over. It was the first point I've been making to the Chinese over the last 3 or 4 years. The rest of the world understands this, but the structural changes required to actually adjust to that are incredibly difficult, particularly for some of the big emerging countries, and quite particularly for China, whose entire structure of the economy is geared away from consumption. Now, finally, my very last words, since I've got to the end of my time, so that's where I think we are. That's why it's not resurgent. What about the future of the US economy? I think that despite the fact that I do expect the US no longer to be the world's largest economy within 10 years, nothing is certain, but I think it is probable, even at market prices, by the way, not just purchasing power parity. I expect it to continue to the world's leading economy in terms of technological innovation. I think it continues to have enormous strengths and can make them greater. It will probably, but not certainly, continue to provide the world's main reserve currency over this period, though that's a very mixed blessing. And the reason for that is that the euro is obviously problematic. I'm sure you realize that. And the Chinese are far too intelligent to think that making the renminbi a reserve currency at this stage of their development will be a very good thing. I think it would be a good thing for the world, but I don't think it will be good for them. And I've continued to predict that, and so far the Chinese behavior has been consistent with that view. The US role in the world economy, of course, could never continue to be what it was. 4% of the world's population cannot possibly continue to dominate it in the way it did in the last century or so, or the last half century, and it certainly can't continue to produce something between 25 and 30% of world output. In the very biggest sense, in the biggest part of the story, we should welcome the relative decline of the US and Europe, because it merely means that the rest of the world has caught on to the basic tricks we found in order to raise incomes per head. They're at least as smart and probably 5 times as hard working as we are, so why not shouldn't they catch up? That's what they're doing, and that's why we're moving steadily and progressively into the irrelevance the Chinese think we deserve.
Okay, well, that's all right then. Ewan.
Thanks very much. Well, I'm going to talk about what I see as the most significant threat to America's power and prosperity in the 21st century, which is its exploding public debt problem. If you go back 10 years to 2000, it's amazing that in 2000, when the United States was recording budget surpluses, that everyone expected this to continue far into the future, and there were even predictions that the US would pay off its public debt entire public debt by 2015. Nobody thinks that now. In the last 3 years, the annual deficit has averaged 9% of GDP. It was previously only above 5% GDP 3 times since World War II. Now we've had 3 9% deficits and 3 consecutive $1 trillion deficits. What I'm going to argue is that this focus on the current deficit, which is being promoted by the Republican Party and their Tea Party allies, isn't really the real issue. The real issue with the deficit isn't the short-term deficit, the deficit that we have today. It's the medium to long-term deficit, which would have happened even without the current crisis. The United States would have headed into some kind of debt chaos. It's certainly been made worse by the current situation, but the current situation hasn't created it. Now, in large part, the 8.7% deficit for 2011 is a reflection of the state of the economy. Whenever you have a recession as serious as this, it's bound to have an effect on the public finances. And this is reflected in the fact that taxation revenue at the moment in the 2011 budget was about 15% GDP, whereas the historic 25-year average from 1980 to 2005 was 19%. So a lot of that decline is due to the automatic decline of economic activity, which is then reflected in lower tax revenue. And similarly, spending is around 25% of GDP compared to the historic average in the late 20th century of about 21%. Now, in the case of spending, a lot of the spending growth is actually related to the recession. A lot of extraordinary measures have been undertaken by the American government, which have inevitably pumped up expenditure. The obvious examples are the 2009 stimulus bill, $787 billion to be spent over 3 years, the motor industry bailout of 2009, and of course the bank bailout of 2008. These are the large ones, but there are others one could cite. Now, these measures help to contain the scale of the downturn. Without them, the downturn would have been very much worse than it actually has been. And the criticism that's most often made by many economists about the Stimulus Act of 2009 was not the scale, was not that it was too large, but it was actually too small to bring about recovery. It might have prevented a larger slump, a deeper slump, but it wasn't enough to really boost recovery. Now, there's a lot of talk today, although the most recent growth figures might tell the lie to that, but there has been considerable concern that the United States faces a double-dip recession. In other words, before recovery from the last recession is complete, we'll slip back into a new one. Now, it's important to realize that a lot of the expansionary fiscal measures that the US government has promoted are set to expire at the end of this year. The stimulus bill expired at the end of fiscal 2011, and that fiscal year ended just a month ago. At the same time, two other expansionary measures are set to expire at the end of the calendar year. One of these is the extension of unemployment insurance benefits to workers who have exhausted their benefits, and the other is the reduction in the payroll tax that business and workers have to pay on their employees. And if that payroll tax cut isn't extended, if the unemployment insurance extension isn't also extended, then the economy will lose the equivalent of about 2.5% GDP of stimulus next year, making a double-dip recession in an election year a possibility. And of course, if there is a double dip recession, it's going to extend the period of running deficits. The longer the slow recovery goes on, if there's a double dip recession, it'll make deficits worse again. The first key to deficit control in the short term is economic recovery. Economic recovery is essential to create the foundation to get the deficit under control in the medium to long term. Now, I started by saying that the real problem wasn't the short-term deficit, but the medium to long-term ones. Now, I'm saying that because on current projections, without a course correction, we sincerely hope that one is made, but without a fiscal course correction, the public debt will reach its historic peak of 109% GDP in 2023. The United States ran a public debt GDP in terms of GDP of 109% when it was paying off its World War II debt. The massive deficits it's been running for quite a few years now, they're going to and will run continually. They are going to accumulate, and in 2023 will be at the level that the United States was in terms of debt GDP ratio at the end of World War II. By 2035, I know this sounds a long way away, but 25 years, if you think back, well, what was 25 years? When Ronald Reagan was president. 25 years on, by 2035, the debt GDP ratio is estimated to be around 180%. Before that happens, the American economy will be in deep trouble. Back in the Civil War in the 1860s, when the United States saw its public debt quadruple during the Civil War, Abraham Lincoln famously remarked, "Men cannot be much oppressed by a debt which they owe to themselves." The only problem is the Americans don't own the debt themselves. A lot of it is held by foreigners. No one knows the precise amount, but it's around 40 to 50% minimum. And if the United States doesn't get a grip on its public debt expansion, foreigners will flee the dollar. They'll simply stop buying treasury securities, and the only way that the United States will be able to sustain itself is by huge interest rates to attract in treasury security buyers from abroad, and that will have a catastrophic effect on the economy. So timely action is needed, and the trick for the United States is that the timely action isn't too soon in order that it chokes off any hopes of current recovery, but is timely enough so that the long-term debt problem doesn't get out of hand. The root cause of the long-term debt problem is the growth of entitlement spending. Three programs, and they are domestic programs, underlie the debt problem of the United States. Social Security, Medicare, Social Security, the pension program, Medicare, which is healthcare for the aged, and Medicaid, which is healthcare for the poor. Now, by 2030, I'm using current projections now, things could change if there are policy changes, but by 2030, these three programs, these three entitlement programs, plus debt, interest payment on the national debt, will consume the entire revenues collected by American government. Everything else, including defense, will have to be funded out of the deficit. So entitlement reform, getting some grip on entitlements in order to reduce costs, is critical over the next 10 years or so. The only problem is that these programs are backed by some very powerful constituencies, and entitlement reform is going to be very difficult to achieve in political terms. But it's not only entitlement reform the US has to undertake. The US is also still paying for the costs of George W. Bush. The revenue loss from the Bush tax cuts of 2001, 2000 and 2003, and the ongoing costs of the Iraq and Afghanistan wars, plus related debt service payments, accounted for $500 billion of the $1.4 trillion deficit in 2009. And in aggregate terms, it has been calculated that they will add some $7 trillion to the deficit between 2000 and 2020 in aggregate. So the United States has got to get its deficit and debt problems under control. If it does not do so, it faces a very bleak economic future. Thank you.
Thanks, Jim. Phil.
No Americans, but I'm Irish, so I suppose if things hadn't gone as well as they did in the 19th century, I could have been American. So, okay, my take on the big picture of where the American economy sits today. I'm going to present a three-part proposition, related to the recent recession in the United States, and I'm conscious that it's a bit blunt. I might be seen as a bit wacky, but bear with me as I outline it. First part of the proposition is that the recession has brought out into the open that the US economy is in a terrible mess. Second part, but it has not had a terrible recession. And the third part of the proposition is that in some ways, America's prospects would be better today if it had had a worse recession. Okay, bear with me. First part, the recession that has brought out into the open that the United States is in a terrible mess. Okay, I think that probably is the least controversial of my three parts, and it's been amply covered by Martin and by Ewan in terms of describing some of the features of the terrible, as in the awful mess that the American economy is in today. So that gives me the opportunity to move on to the second part. I would just stress 2 points, though, about the mess it's in today. I think the severity of the circumstances of the American economy is that whether it goes towards a double-dip recession, another recession, or whether it stays out of recession, and remember, officially America has been out of recession now for, since the middle of 2009, so over 2 years. I think we should call a spade a spade. Whether it's in recession or not is pretty immaterial. The United States is in a depression, and that's what's been brought out into the open by the recession. So the second point I'd stress is that I also feel that this recession, the 2007-2009 one, did not precipitate the depression that it's in today, did not break the American economy. The American economy has been broken for a very long time, and in fact I think there's been really a depression in different forms, different manifestations going on really since the 1970s, but it's been covered up for a long time. Second part of the proposition is that it has not had, the United States, a terrible recession. Now here I'm using the word terrible in the sense of, in the meaning of intense or severe. And saying that, it sounds a bit odd because I can equally agree with what Martin has said, is that by some very key measures, the American recession that has just been through was the most severe recession since the Second World War. It was the longest recession and it was the deepest recession. And that applies to output, and I could give you similar figures as Martin has in terms of what's happened to employment levels, in terms of what's happened to living standards. By many of those, very important metrics, it was an extremely severe recession. But the point I'm stressing is that I'm talking about, was it a severe recession in respect to the destructive consequences that it had on American capital? And recessions, classically, historically, play the role of having a destructive impact. What recessions are supposed to be are destructive cleanups. They're supposed to be the way that the economy purifies itself, re-establishes a basis for being able to go forward again. Recessions are supposed to be about getting rid of the weaker, unproductive, uncompetitive parts of the economy, and by getting rid of the dross, sets things up for a new phase of growth and expansion. Recessions were the vehicles, or traditionally are supposed to be the vehicles, for Schumpeter's famous comment on the essence of capitalism as being waves of creative destruction. That's what historically recessions have played the role of, and that certainly applies to the recessions of the 70s and the early 1980s. And my argument is that this recession that we've been through, however dramatic it was in terms of the falls in employment, in output, in living standards, does not fall into that category. Those metrics have fallen so much, not because of the destructiveness of what happened in those 18 months, but because of the artificial character of the peaks of the highs which preceded it. That the highs in employment, the highs in output, the highs in wouldn't say highs in living standards, but the highs in output and employment in 2007, before the recession struck, were in many ways bolstered or bankrolled by a very artificial thing, all that debt, credit, funded activity of the 2000s, of the noughties, which, as has been explained by both Ewan and Martin, was not endurable. Let me give you one illustration. Let's look at what happened to employment areas. Which were the key employment areas which rose during the 2000s and fell away in the recession? It wasn't manufacturing, different story there. The recessions, the areas of employment which rose and fell were construction, symptom of the housing bubble, were retail and wholesale, symptom of the big expansion in consumer credit, and thirdly, in financial and business services, generally a feature of the broader financial bubble which was going on. So the areas which saw growth were artificially sustained by that credit, which both my fellow panelists have explained is unsustainable in the long term. What that means is that the various collapses which we saw in economic metrics since 2007 had more of the character of a return to earth from some very frothy clouds that people were believing the American economy was in, which is in contrast to what recessions used to be, which is much more hitting a brick wall, forcing a shake-up, often against the interests of the business owners, and setting things up for a fresh start. So we have this continuity, I'm saying, between a frothy, credit-informed expansion, which was really very artificial during the 2000s, followed by, in this respect, a false recession, some ways, because it didn't play its normal destructive role. And that's what set is into the continuum of today, which is what everyone has described, which Martin very well anticipated in his writings, which is a very elusive, sluggish recovery phase at the moment, which doesn't really warrant the phase of recovery. This leads to the third part of my proposition, which is, to remind you, I said that in some ways, America's prospects would be better today if it had had a worse, that is, a more destructive recession. Now, obviously, that sounds the wackiest, a bit heartless, you could say. But the rhetorical point I'm making here is that if you don't have a recession which plays that shakeout, that cleansing, that purifying role, if you don't have something which is setting up the economy for a fresh start, and if I had time, I'd be arguing that really most of the recessions since the early 80s have not had that thoroughly cleansing role, then something else has to take on the responsibility for the new start. If it's not the semi-spontaneous outcome of a market recession, then some other way has to be found to get the American economy out of the torpor and out of the terrible mess that is in today. And my conclusion, now, there is only really one body can do that, which is the state. It's only really the state that can lead this necessary structural overhaul. We've had lots of people talking about, if you follow your commentary, talking about great moderation periods, talking about a great recession that's happened. What the state needs to do is to initiate a great reset, a great restructure to get things moving again. The US elite, whether it's in the White House, whether it's in Congress, whether it's at the Federal Reserve, have to, in order to get things moving, they do have to desist from this continual obsession, an exclusive obsession, with simply applying another bit of first aid, another sticking plaster, whether it's another bit of so-called Keynesian stimulus, or whether it's another bit of abnormal monetary policy, or whatever, because these are having not just a lesser effect, certainly a lesser effect, but they're actually prolonging the woes and getting in the way of what has to happen for the future of an American genuine recovery. What we need is a radical economic shake-up to force a renewal, and with good social safeguards for those millions who will inevitably lose their jobs during that transition period. What does this shake-up mean? I haven't got time to go into details, but it could mean, or some of the features of it, could be a state-led, and I'm not necessarily saying a state paid for, because there's plenty, as Martin said, plenty of American businesses have got loads of cash on their balance sheets at the moment, and there's loads of cheap credit around. But it could be state-led investments in transport, communications, infrastructure. Lots of people have written about how decayed and decrepit the American infrastructure is. It can mean support for research and development, for new areas of innovation. It can mean support for startups. It can mean kick-starting some some whole new technological areas which aren't very difficult to identify. You know, we've been talking about them for 15 years now: biotech, nanotech, alternative energy sources, and so on. There's lots of areas which the Chinese and others in more dynamic, innovating parts of the world are looking at, but aren't happening in anything like the extent which they could be in the United States. So to end, what I'm saying is that there's no painless way out of the dilemma which America and many other Western economies have today. But the pain of further protracted decay, which is what is on the cards at the moment with the sort of initiatives which we're seeing from the political establishment, is, I would argue, much worse than the pain of a substantial economic restructuring and reset. In short, America's prospects, the possibility of providing jobs and prosperity for its people, and America's role in the global world are tottering on the crucial question: can the United States, intellectually, through an extensive public debate, get to grips with the severity of its position, with the chronic, not the acute character of its position, and therefore recognise the need for radical action? If it doesn't, then it will continue downwards. If the elite continues to bury their heads in the sands and simply apply yet another bit of sticking plaster, then the continued increasing dependence of America and the rest of the world would be the picture that we would see.
Thank you, Doug. So could we sort of start there maybe on the panel, because Martin and Ewan, in your various ways, I think, must end up in a position, I mean, Martin, you said it explicitly, that America should just accept it's a sort of game over pretty soon. You can't say when, but face it, you know, there's been a shift, it's been a shock, and it's going to carry on. The only way out you seem to offer for them was to become a net exporter and to say they can't. Whereas you're arguing the other way around, that they have to reduce their deficit budget, but what would be involved in that? Slashing Medicare, Social Security, and Medicaid, they won't, right? So either way, you're not allowing a real option out. But what about the possibility that Phil is putting on the table? I mean, one form of this is the argument made in a book called The Corruption of Capitalism by Richard Duncan. That has America not got an opportunity before it's too late to sort of come out fighting, to use its bigness while it's still there, to borrow in the markets to the extent that it could, you know, raise $3 trillion and cure cancer, rebuild its infrastructure, put in alternative energy? Does it really just have to accept and give up, or are there options like that?
I wanted to comment on some of what Ewan said, because I'm much less pessimistic about the public finance position of the US than he is, and I think even in the long run this is greatly exaggerated. But I will ignore that. We can come back to that later, because it's something we probably obviously both looked at very closely. I'm going to suggest that Phil wasn't radical enough, or he didn't carry through his own radicalism. So I wanted him to articulate this further. I see what he's suggesting as having two sides. One, which he articulated quite clearly, was that the state in particular will be the leading agent in encouraging what I think of as a dynamic investment program in the future of the country. That's broadly what he set out. And I regard that as the intelligent Keynesian solution. I don't think that's anti-Keynesian, that's what a Keynesian would recommend in this situation. Since it's a I've argued about this in the past, since it's a long-term problem, not a short-term problem, since you want structural change as well as sustaining demand, because you don't want a true depression of the 30s style, it makes eminent sense. If you're going to run a fiscal deficits of 8, 9, 10, 12% of GDP anyway, why not borrow and invest them in useful things? I've made exactly the same argument in the UK again and again and again with absolutely zero effect. It is quite ridiculous, if you're going to run fiscal deficits for a very, very long time, and we are, to use them to support consumption rather than investment. What have we done in the UK? We've slashed investment. What are the US doing? They're slashing investment. So I have no problem with the principle on that. There is a great deal of problem in terms of how you organize it, what you put it in, how you marry it up with the private sector, how you set it politically in the US. My God, that's a nightmare. But the principle seems to me right. The deficits are going to be there. There's nothing they can do about them. They're baked in for many years. I agree with Ewan on that. And you might as well use them in sensible ways. The second point, though, he didn't elaborate on, which is actually the thing I've been thinking about most, and I don't know where he stands in the end, which is, in addition to that stuff, do you want to promote mass bankruptcy in the private sector? Now, there's a tremendous amount of bankruptcy going on in the American household sector at the moment, a tremendous amount of default. You could have done it a bit quicker, maybe. I don't think it's easy to argue that that's a real problem. As he said, the construction sector's collapsed anyway, so that bit of clearing out hasn't occurred. Ditto retail and wholesale. There's been a tremendous amount of sorting out, less outright bankruptcy, but a lot of closure. The sector where there hasn't been the liquidation is finance. And if we're going to talk about this rigorously and explicitly, what we have to address is the question, and I thought about this probably more than many, but I don't have a clear answer, is should we have let all the banks collapse? Because that sure as hell would have been Schumpeterian. Unfortunately, Americans tried that in the 30s and they didn't like the result. And I'm not sure they would like it now. But that really is the sector, and I want him to articulate that specific issue. So it seems to me on the core package that if you're going to have a hell of a lot of government spending, you might as well do it to promote the future. That's fine. And then there's the question of bankruptcy. One final little point. Assume they do all this right. You must qualify what I said. My proposition of the future is, let's suppose the Americans do everything right. They're the richest country in the world. They're on the frontier of productivity. Everybody knows what long-term trend productivity growth at best is. The US might be able to grow at 3% a year, or maybe even 3.5%. That will be very, very good. In this situation, it will still be in relative decline. It will be completely normal for it to be in relative decline because China, that has all the catch-up possibilities as well as this trend growth in its favor, is going to grow faster. In the end, an economy with 4 times the people is going to be bigger. End of story.
I absolutely agree about the fact that the deficit debt issue is utterly divorced from the necessity to invest. Most of the long-term problem is payment to the past, to old people like myself, I can say that. Pensions, healthcare for the aged, not that the aged don't deserve a good deal, they worked hard throughout their life, but fundamentally it's a totally imbalanced fiscal system. But when I hear, wonderful to hear this rigorous economic debate, and I suddenly think to myself, hang on a second, there's people in here as well, and they're called politicians. And the problem with the United States is that its political system, if you divide the political system to find the perfect way not to deliver good economic policy, it would be the American system. Okay, if you have fiscal policy, somebody's got to make fiscal policy, but who makes it in the United States? The president in February every year delivers a budget plan. Congress then spends something like 10 months deliberating and devising legislation to spend and tax, and all kinds of compromises get done. Very often the budget isn't delivered on time, so you have to have a continuing resolution. The kind of economic policy that is rational, and I have some sympathy with what you're saying, not total sympathy, is going to be very difficult in the United States. In the British parliamentary system, a budget is proposed, it's effectively enacted within 2 weeks. Whether you like that budget or not, it's a very effective system for delivering one. Economic policy is very difficult to deliver in the United States. Fiscal and monetary policy are completely separated, and President and Congress have differing powers over the budget. And I can't see all of these things ever coming together to deliver the kind of rational output that you'd like.
Well, just on that point, I mean, I think you're making too much of the peculiar sort of institutional checks and balances and the way the American political system works. I'm pleased that the focus has gone on to the political problems, though, because it is the political problems which are shared in many, many different types of Western sort of democratic institutions, in Britain as well, I would say, as well as most of the rest of Europe. The problem is that there isn't a debate about these things. There is a failure to engage with people on what are harsh decisions. Instead, what is happening is that I think there is a cultural denial taking place as to how bad things are. So the mechanisms behind the sort of radical sort of industrial policy I'm putting forward, or not quite so radical, the semi-radical policy I'm putting forward, as I would say, the specific features of it are less important than the fact there needs to be a public debate taking place in America, in Britain, in any country which is grappling with these very severe problems. My simple point that I was trying to make, and the one point I was trying to make, is that things are a lot worse than people perceive them to be. And for as long as politicians hide from that and deny that that is the case, and can continue to exist in their relative aloofness and estrangement from the real world, then things are going to go from bad to worse. On the specifics of liquidating bankrupt companies and bankrupt banks, I would say yes, that's part of the policy would entail not propping up what is no longer socially beneficial. I mean, I did throw in this phrase, and I know it's a quick phrase to say, but the state should take responsibility for those who are thrown out of work during this period of transition. But, that they should take responsibility for, the living standards for those people as the new industries are built up. I'm not saying there's a way of doing it that all of a sudden you have this whole new industry set up, the nanotech, the biotech, and the jobs are all sitting there, and people can just go from the old car plants down the road and start their new job in a new area of manufacturing. Clearly, that would be crass. What I am saying is that transition has to take place, and there has to be a public debate to argue and motivate why the perpetuation of the present is a way of not just perpetuating the existing level of pain, but things will continue to get worse and worse. To conclude, I'm quite in agreement with Martin that relative decline will continue, even if the sort of liquidation of the weak and the build-up of the new through the sort of initiatives I'm talking about were taking place. That's quite right, but it's a matter of there is relative economic decline and there is relative economic decline. There is a relative economic decline which is driven by the moribund character of your domestic circumstances. That's what's happening at the moment. And there is a relative decline in which the whole world is seeing increasing levels of prosperity. And as you say, the half of the world which has missed out for a century and a half can benefit from that prosperity. That sort of the latter sort of relative economic decline is obviously of a very different quality, both in practice and also in terms of what it means for its people, than the relative economic decline which we've seen for the last 30 years on and off.
One thing to also bear in mind, I think, is the political context in which this is happening. So Occupy Wall Street protests, for example. So when we're considering the economics of whether or not America can be relatively resurgent or relatively more dependent, and over what time frame, I think we have to consider the impact of subjective and political factors on that. I mean, there is the American dream already something tarnished that even if it could be recovered, the American people don't want quite so much as they sit out, attacking finance. And I think they're not doing it in the way Phil would, that is sort of absolutely hostile to banks, not just bad ones. So those political factors are something to consider, whether or not there is a will and a dynamism at a subjective level within America to do something about it.
Just, first is an interesting observation in terms of the Eurozone crisis, how the US has actually sided with some of the more destructive tendencies in the European discussion. I would argue, i.e. the obsession with fiscal union and discipline and overly leveraged bailout funds, but that's an observation. I really want to ask a question about the whole default issue, because I do think it is quite important to the realities of this debate. The whole bailing out, or the whole assumption of senior bank debt has spilled over into the sovereign bonds market, and we can see this most clearly perhaps in Europe. But sovereign bond markets themselves, a product of the kind of post-war era, are the way by which states finance themselves. So here we do seem to have a kind of double bind, which is without taking on the default issue, not only can you have a problem repurifying your own economy, but the sovereign bond markets themselves have been contaminated and need some purification, which might make the state investment product more difficult. So what I'm saying, I suppose, is part of the US dilemma about sort of tearing things down to begin again mean that we have to look again at something as fundamental as the sovereign bond market, does that need to be sort of torn down a peg or two?
Just a very quick question. I mean, the panel's been discussing it in terms of how the US gets a grip internally, politically, and so on. Is it relevant to talk about what China's role in this is going to be in terms of their vast reserves of dollar, and whether they actually have a political project to do something positive rather than watch the value of that collapse or erode? Because surely they have an interest in doing something with the reserves that they have built up out of the broken American economy over the last 10 years. Is there going to be a political dynamic foreseeable where China has a positive role to play, actually?
Well, it's a good question. There's also a flip side to that, is that what happens to those reserves if the US abandons its kind of strong dollar pledge?
Some of you, at least two of you, seem to be saying that redirecting government spending to investment would be a better thing. And yes, indeed. I mean, I think we know that to grow, you need to invest first. That's what we do in a business. Usually you save before. The government prints money, which I don't think is the same as saving. But to do that, to redirect money to investing, I suppose you need first to reduce spending on entitlements, for example. And how do you possibly do that? I don't see in the current system, how can elected leaders who have elections every 4 years ever reduce these things? Aren't we witnessing a failure of democracy in essence?
Just following on from Bruno's point and the gentleman in front, in a large sense, isn't the problem that we're in terms of the global economic crisis, one of excess liquidity generated by massive exports from China, continued consumption in the West, Europe and the US? And in a sense, are we then in a bubble economy such that if there is a default by the US that would enable it to start from a fresh sheet, then that rebalancing can be made so that perhaps, with a readjustment in relative exchange rates between the US dollar and the renminbi, we can see a regrowth in the manufacturing industry of the US to correct some of the problems that have led us to where we are, which is the complete annihilation of manufacturing in Western economies.
Just a couple of questions for Martin. One is just a question of clarification, because you mentioned that rapid economic growth in China had led to widening inequality in the US, and I'm not sure of the mechanism you're arguing for that. Secondly, more fundamentally, and it does relate to the debate in the panel, is I'm not sure why you place so much emphasis on the demand side of the equation, or in relation to consumption. So when you were talking initially about America's prospects, you were saying, well, it's very limited because saving levels are very low, so people can't buy more, so demand can't take off, and that's a real constraint on the American economy, apart from these yacht owners who don't want to spend their money anyway, because they're already spending loads of it. But why emphasize demand so much? Why put so little emphasis on supply and the possibility of bolstering the production side of the economy? And I should say, to be fair, that isn't just a characteristic argument unique to Martin. I mean, that's very, very common when you read commentaries on the world economy. And I'm not quite sure why there is such an emphasis on the demand/consumption side.
I think if I understood the question on the banks and relationship between banks and the sovereign debt market, I think the US was essentially unaffected by the bailout of its banks fiscally, directly. That's the crucial point. The US banking system balance sheet is very small relative to US GDP compared with that of any other significant economy. It's 1 times compared to 5 times here, quite a big difference. And the money put out is going to get back, so it won't affect the debt. The US debt explosion follows the recession or the depression, or whatever you want to call it. It's about levels of activity, revenue and spending, which was described very well by Iwan. It's nothing to do, I think, with its implicit liabilities to the banking sector. different, slightly different here. My view has always been, and this is where I come to with you, and I think actually, but I don't have the time to explain why, that the US is going to have absolutely zero difficulty in funding itself for a very, very long time. Interest rates are not going to explode upwards. It's going to be much more like Japan, because its relationship to the world is like the Japanese government's relationship to its own citizens. The US is not a normal country. It's really important to understand that. We can't analyze it just like other countries. And so I think the problem for the US is that it's going to find it so easy to fund all this. And quite apart from that, the US cannot default. It has a central bank. Look, countries with central banks can't default. They can just inflate. And that's what they're going to do. Now, this is really very important, because it really explains why all this yammering drivel we get about how the UK is just like Greece is such yammering drivel. Now, the two other points. Say first, before we do this, the problem in the US at the moment, and this is why I'm completely comfortable with focusing on the demand, you have a demand problem. Since I don't believe in Say's law, I don't think anybody really did anymore, except people who win Nobel Prizes. The problem is there is a colossal financial surplus being run by the US private sector. It's spending vastly less than its income. So the savings are there. Somebody has to borrow them. If they run a current account surplus, the foreigners borrow them. The foreigners don't want to borrow them. They want to run a current account surplus with the US. So the government borrows them. You might as well borrow them to do something useful with them. That's all. Really, there is more than one sector in an economy, and you can't look at the US with the fiscal side without looking at what's going on in the others. That, I think, is my response on the demand side. So supply increases are great, provided they lead to current pari passu demand increases, and they might not, and they might yes. Finally, China's role in all this. China's role in all this is to lose money. I have made this point to the Chinese leadership at many levels for 10 years. If you invest if you provide a country with a vast amount of valuable goods and take in return paper whose value can be determined by the recipient, you're going to lose money. That's what happens. So I refer to China, a significant part of Chinese exports, as China's gift to the world. And we should probably be quite grateful. To expect after the fact that they will get back in real value what they gave away is, I think, deeply naive, and it's not going to happen.
My interest in this is not in the sort of practicalities of how the structural overall would happen, but I mean, I think it is worth endorsing what Martin has said. There is no question that an economy like the United States cannot borrow the money, and nor does it even have to borrow at all, because there's a huge amount of savings in American companies at the present time, which are just sitting there. My concern, my main interest in the subject, is how you challenge and shift the mindset, the cultural mindset, which is both amongst the politicians and amongst the business leaders, which is not looking to any sort of strategic resolution to this, but is looking to simply muddling through, hopefully till the next election, hopefully till the next round of results can come out. And it's the cultural myopia, which is the one which is most interesting. And I think a lot of the discussion, the one point I would say, I mean, an area which I'm not agreeing with Martin in, is one of the areas of discussion which I think blur what needs to be done is this discussion about rebalancing, which is a very common proposition coming from the economics world. Obviously has its roots in equilibrium analysis and so on. But the idea of rebalancing the world or rebalancing a domestic economy, it sounds very benign, and it sounds you just have to take a bit from here and use it there, and you have to sort of stop Americans consuming so much and save more, and the Chinese could do the opposite, and then sort of lo and behold everything would be all right. But this is a discussion which I think does ignore what is happening at the level of production, as Daniel back there said. Because if as the Chinese are, I mean, the Chinese policy is to consume more. That's the planning from top is to try to raise living standards and to increase consumption domestically. They can see some of the things that Martin and others have described. But if the Chinese middle classes are consuming a lot more, there's no reason to think that the Americans are going to be able to export to that market. What matters is the competitiveness of American exports. So it isn't a demand question. It's not a question of rebalancing demand around the world or rebalancing demand internally. It's a matter of getting to grips as to whether you're able to produce things at a sufficient surplus to be able to sustain a dynamic of future activity. That's where the American economy is in a mess. You have, Martin asked me directly about, liquidating businesses. I think what was done with the car industries was an example of what shouldn't be done in the United States. They bailed out the car industries. It looks okay for GM at the moment, but I can tell you they haven't restructured. If you look at what happened with the money that went in and what happened with the changes, it is another short-term fix, maybe a couple of years. But they should not have simply bailed out that in the hope of keeping demand afloat and so on, but recognise that there does have to be the building up of a new type of industry, perhaps on the basis of really exporting to the Asian markets of goods that they want, the type of goods which they need for the future of their development. You need to build up something new, which means letting the old die away and helping the process of transition from A to B.
I agree that there is the drive to invest, to rebalance is necessary. And what is the force that's going to bring this about? Well, the state is going to have to play a very important role in it, but it is at the very moment when the United States has taken a dramatic turn to the right. The Tea Party and Republican success in the 2010 midterms, who knows what's going to happen in 2012, but the possibility of a progressive view of statism, I think, is very slim over the next few years. Secondly, the question down here about the manipulation of exchange rates. If you think about this historically, out of the depression of the 1890s, which they used to call the Great Depression in the United States, came structural reform in the shape of the establishment of the Federal Reserve System in 1913. Out of the depression of the 1930s and World War II came the Bretton Woods system, underwrote the restoration of the global economy. I don't see that happening now because fundamentally something has to drive this. I don't think the United States has the clout or possibly even the will to drive it any longer. The role of the Chinese is critical, and I don't think that they are ready to undertake that kind of dirigious role in world affairs for the moment.
One thing that's sort of coming out on the discussion here is that with nuances and disagreements about how it might be done, there's some sort of consensus that maybe they should, if they could, invest to get the way out of the problem. But Martin said it a number of times, no one appears to be listening at the political level. The Chinese are a little bit, it feels right, which is good. But why not? Is there just an absence of political will? And does that mean that we're just stuck in an impasse?
This is a question to the last speaker who suggests that the cleaning should come from the state. So the market didn't do a good job. There were not enough bankruptcy and not enough changes. And now you suggest that the state should do that. But the state had a great opportunity to do it 2 years ago. They just had to do nothing. And instead, they put $2 trillion on the table. And I don't really see what you mean by this, because state always goes to maintain the status quo. They privilege big business, finances big businesses so that they don't die and are not replaced by new ones, pass laws so that the big pharma are not competing with smaller companies. So what do you mean by the state should help clean up the place and start with something new? Because they always do the contrary.
Obviously, as individuals, we notice GDP per head more than we care about overall GDP to some degree. And I have a question which, to anyone on the panel really, about what is the effect, the relationship between these large macroeconomic and global shifts in the balance of payments and so on, and the rate of innovation and productivity growth in the economies, particularly in the US. So, see, Martin's alluded to the US as being at the leading edge of economic growth. Is there some dangers to do with the rate of innovation and change in economies which might impact the US in the really long term? Because even though it may well be overtaken by China in a total GDP sense, I can't remember whether it was Martin himself who wrote that it seems unlikely they may get, economies haven't approached more than 80% of the US's GDP per head on any kind of long term, simply because of the underlying rate of innovation and productivity growth of that country.
I wanted to ask two things. One is picking up on what Phil said about the areas of industry to invest in to create growth. So biotechs, nanotechs and all that sort of thing. The impression I get is that that is seen as much more risky and it's an area where the investments are falling away rather than jumping in. And where there is some investment, it's in the traditional, let's have a bit of transport infrastructure, or the traditional ways of stimulating the economy. So I can't see where the political mindset and the corporate mindset is going to change from quite risk averse into let's go into some newfound riskier investments, although the return might be more. How's that political mindset going to change? And the second question I've got is, I used to work for a company, a British company, that went and bought an American company that was suffering difficulties. And the thing that I noticed when I went to America is they do have a bit of an issue about foreign ownership. And they don't mind foreign investment in terms of financial. But when you start calling the shots, so if the Chinese take over General Motors, restructure it and put it on a different footing, there are a few political issues there that that sometimes are under the surface but do come right to the top of the agenda occasionally. I'm wondering how those issues can be dealt with. So it's not just about money. There is something to do with the national psyche there as well.
Just before I bring in the next question, Phil, maybe Martin, just on this, because I think it'd be useful to clear it up or tighten up the definitions around what we mean by the state doing something to clear something up, because it occurs to me that there's a good point here. Why did the state not just do nothing? Why did it not let the banks fail in America? Why did it not let GM go to the wall and so on? Could there be a possibility that the same state you're calling on as the possible rescue ambulance might be an obstacle? Right? That it's not in the vested interest of the American state to restructure the economy because the state is such a big part of the economy.
Yeah, I'm using the state not as in the current state as it is composed and as it is as it determines its own way of operating and the sort of approach that it has pursued up to in the recent period. My main point is to say that there is another way to actually change things. My main point is saying that there is not an inevitability for a continuation of that 30, 40-year decline, which I was trying to describe, saying that there have been ups and downs and that's been covered up for a period of time, but really we're talking about a long-term decay in productive activity in the Western economies. And there is a certain fatalism abound, which is expressed in the individuals who operate the different arms of the state, which goes along with that fatalism, which really there's not much you can do. Either bury our heads and hope that things will get better, or, well, let's just do something which will hopefully get us through to the next period and hope for the best that things will happen, what I call the muddle through and other people call the muddle through economy. So the existing operations and the existing perspectives of the state, you're quite right, are a barrier to what I'm arguing. It won't just happen. What I'm saying is that to challenge the cultural mood that there isn't really much you can do about this is just the way things are, is where we have to begin. That there is a basis for a public discussion about it, which can actually show that things don't have to be this way.
On this question of US political leadership, because there doesn't seem to be anything equivalent to the sort of Rostow Cold War stages of economic growth, a real push for it seems to be a very specialised discussion, and there doesn't seem to be any domestic or international pressures to push a sort of alternative sort of the can do that you see as required. If anything, the sort of push that I see in international relations of a sort of the vision is about local production and local consumption.
I'd like to return a little bit to the issue of inflation, because having your own central bank, it seems like what they could do is just to print a note saying 13, a lot of digits or zeros after it, and they'd be all clear. But then someone comes along and say that the Germans tried that a long time ago, and they just didn't like the results. So I'd like to ask you, how do you expect the US to use inflation to get rid or handle the debt at all? And what kind of inflation rates can they sustain without causing further harm to their own economy?
There's been quite a lot of discussion about the slow, steady decay and depression. What precisely caused it,
and to what extent was it inevitable?
Actually, it was a kind of an attempt to respond directly to Angus's, the chair's question. I mean, it looks like governments, particularly in Europe, but Western governments have really focused on controlling their citizens' behaviour in the last period. That's what governments become about. This whole idea of stepping in to reform economies in anything but sort of the most indirect way is so far off the agenda. It's almost unimaginable. It just seems that that's so. There does seem to be a kind of almost utopic element. It may be that the panel in here are sort of in agreement, but virtually nobody in the outside world seems to be in agreement. So I'd like to address that, perhaps.
Yeah, my question's on creative destruction and this idea that we should just let companies or banks, car companies fail. And isn't there a danger that that actually leads to more cutbacks and more unemployment and bigger problems with deficit? I mean, in terms of letting companies fail, isn't that actually what Britain did in the 1970s and 80s? And Britain used to have one of the biggest car industries in the world, and now we've got practically nothing. And the countries which didn't let them fail, like France and Germany, and you had big bailouts, they've still got a stronger manufacturing sector and thriving companies today. So isn't it maybe possibly dangerous to just let things fail, and that actually leads to bigger dependence on the financial sector like we have in Britain?
Yes, I'd also like to ask about monetary policy, and my question to the panel is gold money? And if it is a commodity, why are the Chinese buying so much of it?
I was in Washington, D.C. recently, and I saw the advertising campaign in the window of a bank close to the White House was a picture of a big jar of coins and saying to people, bring your coins in and we'll sort them for you to pay them into your savings account, which I think is quite a good indicator of many of the things that people have been saying and about the depths of the problems there in America. But it seems to me that if the problem is that the money is not going to the right places, if the economy is not being stimulated, okay, perhaps we should try and get the state to sort this out. But people see this as very problematic and unrealistic. To what extent can things be made better by the state interfering less, stopping to prop up the unproductive parts of the of industry and allowing the markets to operate, allowing capital flows and investment to go to the more productive areas? Isn't it more realistic to hope for the American state to interfere less, rather than hoping that they suddenly completely change the policy and their mindset and sort things out?
I'm wondering to what extent you might agree with me that the real barrier to anything positive happening in this area is the fear the elites presently appear to have of their own populations. Because certainly in Germany, this is something that is very striking. It's the place I come from. In the Eurozone session earlier on, it was argued that the German government is reluctant, I'm sure this is the way it's being discussed in Britain, reluctant to put up more money because they think they won't be getting it back from the weaker economies. Well, I think the German government gives every impression of being reluctant to do anything tricky because they have a great fear of their own electorate. And I think this is I'm asking you, don't you think that this kind of lack of political engagement with people is really becoming in itself a barrier to any progress in the economic sphere? And so I'm really grateful also that in this discussion we've come away from always looking just at the technicalities, because I think it does have a lot to do with the political malaise of Western societies at the moment.
Give us your summation of all that in about a minute, Ewan. That would be great. Thanks.
Well, I suppose I'm an old-fashioned lefty, coming back to this point of whether the market could sort it out if government stepped back. One of the problems, part of the problem is that government stepped back. Repeal of the Glass-Steagall Act, you go back to in 1999, preface the subprime crisis, you go back to the 1980s and the age of Reagan, when there was a lot of tax cuts that flowed into business, and what did business use that money for? Well, shopping malls, office buildings, construction. The short-term thing. I mean, the problem it seems to me is that we're after the long term, and both in politics and in the market, the short term appears to be privileged. On the political side of things, we do come back. Barack Obama in 2008 was being heralded as the new Franklin D. Roosevelt. I have a terrible feeling he's going to go down in history as the second Herbert Hoover, because not that he has been a failure as president, but that the sort of statist solutions that the Democrats were envisaging round about 2008, 2009 have generated this intense political reaction, and in complete contrast to the 1930s, the social movement, the socio-political movement that has emerged in the United States isn't of the left, it's of the right.
An whole country only having two Hoovers isn't very good anyway. Phil?
There's a book which Martin referred to, the Reinhart Rogoff book, which is a book called This Time Is Different, which came out, 2 years ago, Martin? Was it? Or 3 years ago? Basically analysis of the 8 centuries of financial crises, and it came out just at the time when the discussion was going on, what's the impact of the Western financial crisis, what's it mean? And this thesis, Carmen Reinhart and Ken Rogoff, argues that financial crises are different, they're qualitatively different to other types of economic crisis, and that the historical experience is that they lead to long periods of sluggish and very protracted recovery. Others have described the same perspective as the new normal. The idea that we've gone through something, we've gone through a super debt cycle, and basically we've got to pay the consequences of that and expect to have a very, very long period of sluggish, low growth in the Western societies which have gone through this credit cycle. My main argument has been to challenge that sort of fatalism, to say that the position of America, to take as that's the focus for the discussion, the position of America in the world, the prosperity or otherwise of America over the next period, is not predetermined by that idea that we've had a financial crisis and things are bound to be tough and we've got to pay for it. It's not a new normal, that somehow this is the way things have to be. There is another way of doing it. The discussion I had about new industrial policies and stuff was, I hope you've seen, secondary to my argument. My main argument is the one that Sabina has put, is that the problems are not really economic in the way of the Western economies. They are much more political and I'd call cultural problems, that there is a mindset, a very short-termist and myopic mindset that you can't do anything except try and just muddle through to the next period. And we have to accept the expectation of things being very bad for a period to come. There is a sort of byproduct of the idea of American being dependent, that everything will be in the hands of the Chinese. And I would say there was a question earlier, will China play a positive role? The reality is China is playing a positive role, whether it wants to or not. It was China that stopped the recession in the West, the financial crisis becoming a depression. It wasn't Keynesian policy, it wasn't monetary policy, it wasn't fiscal policy. It was the fact that the Chinese are producing lots of value and opened the floodgates to help the world economy get through that situation. That's because they are based on an economy based on the production of real values, as opposed to the parasitic way in which Western economies are working. If you produce values, you can do things. If you don't produce them, but live off the rest, then you are in shtuk. And my argument is there's no reason for the Western economies not to be able to avail themselves of this tremendous growth of new value production in Asia and actually see that as an opportunity to shake themselves up. But the challenge is the political and the cultural one. And so this is very much a call not for a new industrial policy, it's a call for a debate to challenge the idea that nothing can be done.
There are so many different questions. It's a pity we didn't get to this point earlier, because it begins to articulate clearly how far I disagree with Phil. But let me, and I'll come to that in the moment, because there's a point perhaps I failed to get earlier. I'll make the following 5 points, and I will ignore, I deeply apologize for all the many interesting questions I will ignore. I'd love to have longer, but I don't. First, it is the case, and we've all commented upon this, that over the last 40 years, and to an increasing degree in the United States, politics has swung against the state. And the conservative movement, Barry Goldwater, I'm old enough to remember this, was regarded as a complete lunatic, and Barry Goldwater will be way to the left of the current Republican Party on almost anything. So there has been this profound swing. It's very interesting why this happened. The great inflation of the 70s clearly played a big role in that. The obvious failures of the state in the 60s and 70s played a big role in that. It seems to have a profound cultural root as well. And I think the biggest part of that, it's obvious even here too, is that the most dynamic attitude among young people is in fact variants of libertarianism. That's way. I mean, compared with my childhood, everybody was a Marxist except me, right? Everybody was a Marxist except me. Now they're all libertarians. I found myself moving from the far right to the far left, with taking exactly the same position throughout. Number two, lots of questions have been raised about money and credit, and they are really too complicated and technical. I'll make only 2 points. Well, one, the SDR can't be a real money because it's not usable by private individuals. It's a government money. It's a settlement money for governments. And therefore it's not a true money. And it can't be a true money, as surely the Euro experience tends to demonstrate, because it doesn't have a state behind it, and therefore it doesn't have a true central bank. Gold could be money, but it isn't. Okay? It's something we could make money. Some people think it will become money again. My bet is no. I think it's very unlikely, but anything is possible. One thing I've really learned is anything is possible. But it ain't money now. It is probably a reflection of fear of money, however, which is another thing. The real price of gold, by the way, is no higher than it was in 1980. It's just been a great big cycle. Oil has done better. Number three, state and market. And the role of state and business. We've got into very extreme positions on all this, which really, really irritates me. It is clear, if you have any reasonable understanding of economic history, that the state and the private sector have both, in complicated and overlapping and interacting ways, played a central roles in economic development, and the same will remain true here. But I would just like to point out, for those who think we should have more manufacturing and less state, that the most important and successful industrial company in the UK now, without a doubt, is Rolls-Royce, and if it weren't for state intervention, it wouldn't exist. And I can remember that. Number four, the relationship between government and the financial sector. This is a symbiotic relationship of incredible danger. I've been involved in discussing this and had a small involvement in one government report dealing with this, which came to very limited outcomes. But the reason that government supports finance is that major waves of banking collapses are a big mess. And big messes you really don't don't want to go through. So unless you can find a way of allowing JP Morgan, Citi, Bank of America, RBS, and sundry other banks collapse simultaneously without imploding the world, it's not worth talking about. That's the whole issue. Because the liability sides of these institutions are everything damn nearly you own. And the final point I would make, which is the real disagreement with Phil, I don't really see this. And in fact, I don't really understand this notion of huge, egregious economic decline that's been going on for decades, from which we have to be saved. There's very complicated things to be said about the waves of technological innovation, the intensity of them over time, and so forth. But the truth is, if you look at the fundamental determinants of economic prosperity, which have not been distributed well, that gets to the income distribution thing that I can't discuss, which is technological innovation, productivity rises, and so forth. The US record as the frontier economy has not been at all bad. And it remains the case that the most dynamic frontier sector of the last 30 years, telecommunication, ICT broadly defined, has been dominated by them. Not exclusively, but it continues to be. And it has transformed the world, which is why I carry an iPad. So it does seem to me, this idea that nothing useful happened, there was no technological progress, this is all complete drivel. It's complete nonsense. There was, on top of genuine economic growth and prosperity, huge imbalances in the world economy, which I've discussed, I can't go in further, which had a very major effect on the way we went, and a permission to let the financial sector interact with the household sector in utterly pernicious ways. That didn't have to happen, and I don't think we have to restart everything from scratch. That's it.
Thank you, panel.